Chapter 12, Financial Accounting, Part 2 of 3, Corporations. In Part 1 of 3, we started talking about the organization of a company. So when only one class of stock is issued, it's called common stock, and that's the term we're used to seeing. And they are called stockholders or shareholders, and each share has equal rights to vote, equal rights to dividend. Now, if a company has more than one class of stock with a lot of different preference rights, such as a preference to dividends, it's going to be called preferred stock. Not all companies have preferred stock. In fact, you don't see it very frequently. Preferred stock dividends are given either as a flat dollar amount, that this stock is guaranteed $4 per share, or as a percentage. Whereas whenever you talk about common stock, then the board of directors will declare the dividend and the common stockholders share equally. But the preferred stockholders have a specific amount that they are to receive. They also have preference as to the very first dividends that are declared, which means they have a greater chance. But since dividends are based on earnings, they're not guaranteed. So as this illustration shows, money available for dividends will go to the preferred stockholders first, and then next the common stockholders. As a reminder, dividends are not guaranteed, but also that shareholders are also not guaranteed any funds if the company goes bankrupt. The money always goes to the creditors first, and generally, when a company goes bankrupt, the creditors are going to get most of the funds out of the company anyway before the shareholders get anything. But if it does come down to the fact that there's leftover money after the creditors have been paid, preferred stockholders will be paid first, and then the common stockholders. Payments of dividends are authorized, as we said, by the board of directors, and it's determined to have been declared a dividend. You may have heard me use that term before, and that is that the board of directors declares dividends. Cumulative preferred stockholders have a right to receive dividends that aren't declared in prior years because they accumulate dividends. So cumulative preferred stock is always better over non-cumulative preferred stock. So what this means is if you own preferred stock and the company doesn't have any money to declare a dividend in 1 year or chooses not to, if you're non-cumulative preferred stock, you won't get that stock. If you are cumulative, then they will catch up and pay you the money that hasn't been paid in prior years that is said to be in arrears. And this money must be paid before the common stockholders get anything. So they're called dividends in arrears. It's generally listed as a footnote, and the dividends in arrears are shown to the shareholders so that they can receive their funds when the company finally declares dividends. Here's an illustration. A company has 1,000 shares of preferred $4 stock, $50 par, and 4,000 shares of common stock, and the company pays no dividends in the first 2 years of the company, but in the third year they pay $22,000. Well, first they have to pay up for the cumulative preferred stockholders who didn't receive dividends because they are in arrears, and then the common stockholders will get the leftovers. So let's look at how it works. So the 1,000 shares at $4 because it was $4 preferred stock. So the $22,000 is declared in year 3. The preferred stockholders get $12,000 of it, and the common stockholders receive the remaining. When issuing stock, a separate account is used for each type of stock. So you would debit cash and credit the type of stock, whether it's preferred or common. Stock is often issued at a price greater than par. And so let's talk about actually issuing stock. We could call this a premium. Now recall that we've had quite a few IPOs. If you've never heard that term, as a business student, you need to. That's an initial public offering, or an IPO. And this initial public offering means that it's the first time the company has sold stock. And so they assume that par is what they're going to receive because that's their best bet, but frequently it's going to go higher and higher. I'm thinking of some recent IPOs. Facebook, Snapchat has had an IPO recently. A lot of these tech companies, these social media companies have had IPOs, and the price at which the stock is sold depends on investor interest and the market for the stock. And so if there is extra, or what we might call a premium, it's called paid in capital in excess of par. So in this example, we have 2,000 shares of $50 par preferred stock sold at 55. So that $5 times 2,000 shares is called paid in capital in excess of par, and it's going to be a separate account. So we have preferred stock at its par value here of 100,000. $10,000 is the paid in capital in excess, and then we have our cash. Let's talk about accounting for dividends and the recording of the transactions. When a board of directors meets, they can declare either a cash or a stock dividend. Now, this may be something that you're not completely familiar with. The book goes into a whole lot more details than we will in this class. A cash dividend means that literally they're distributing cash to the shareholders, but a stock dividend means they're going to give equal amounts of stock. So if one shareholder owns 10% of the company and they receive a stock dividend, then they'll receive 10% of the stock dividend that was declared. And a stock dividend generally is done when the company is weak on cash, but they think that they may have some future advancement in the stock of the company. And it's usually an advantage. The company may say, we're going to give a 15% stock dividend. So a shareholder that owns 100 shares after the stock dividend will own 115 shares. Stock dividends are not taxable. Cash dividends are. But in both cases, as we talked about all throughout this course, when a dividend is declared, retained earnings. Cash dividends are sometimes paid in other forms, and I have to throw this interesting comment. I think it was Jack Daniels back in the early 1900s literally mailed a bottle of their alcohol to the shareholders. That was their other asset they paid in inventory. But generally, cash dividends are paid if there are sufficient retained earnings and cash, and if the board of directors approves the declaration. There are 3 announcement dates whenever a cash dividend is declared. The board will meet and declare the dividend. There will be a date of record, and that's the date when they determine who's going to receive the dividends. Because these stocks, think about it, these stocks are trading every single minute. If you Google any company, go to finance.yahoo.com and select a company, you'd be surprised at how frequently the stock price changes, which means that the stock price is changing hands. So the company has to have a formal announcement and then a formal date of record. Then afterwards, there's a date of payment. There's actually, the stock will sell for more in between the date of record and the date of payment, because the person that owned it as of this date will get the dividend even if they subsequently sell the stock. And that's good for those of you going into the investment business to understand. The date of declaration, as we've said, is the formal date, and that's the date that the company incurs the liability, and the date of record is whenever they will decide which shareholders will receive. Now, a stock dividend, again, only affects stockholders' equity. Nothing happens in cash. And the amount of the stock dividend is transferred from retained earnings to paid in capital, normally at the fair market value. Not a transaction you'll have to worry about recording on an exam, but it is something that frequently you will be dealing with if you're taking an upper level accounting class.